Good afternoon and welcome to the Dairy Signal. We are happy to have you here on this wonderful Thursday afternoon. Before we begin, we would like to thank DMI for being today's sponsor. Your dairy checkoff is at work building sales of and trust in dairy through restaurant, retail, and food service partners, youth outreach, research, and product development, and more. Visit dairycheckoff.com to learn more how they are making every drop count. I would also like to remind everyone to take advantage of the next hour we have with Ben live with us and ask your questions. To ask your questions, please do so by clicking the three dots on the bottom right of the video screen. Press the Ask Question button, fill in your information. It does ask for a name, but you can put in anonymous if you choose. Then finally press Submit. To take the quiz for CE credits, a pop-up will automatically appear at the end of the episode. After completing the quiz, you must select Submit for it to count. With that, we have Ben Buckner, Chief Grains and Dairy Analyst with Ag Resource Company, here to give you a market update. With that, Ben, please take it away.
Okay, well, thank you so much. As always, a pleasure to be a part of the Dairy Signal. And we will jump right into it. There are a million little things going on in the ag space, of course, centered on, do we get trade deals in the next really 6 business days or do we not? And what do those look like? Does it include agriculture? We haven't seen any of those details yet with the deals that have been announced. But otherwise, it's weather, it's government policy. We are still, concerned about feed market oversupply, though this is going to be kind of the silver lining to dairy operations, given the decline in milk values. Then I think what's changed in the last, 2 weeks and 4 weeks is that suddenly we're just awash in milk supplies globally. We have added a lot of cows to the U.S. dairy herd nationally. Europe's doing better than expected in terms of production growth, and so is New Zealand. And so we're kind of on the precipice of the Southern Hemisphere market coming back with their seasonal increase in milk output. So I don't think any processor or importer really has any concern over supplies, kind of in the medium term and into 2026. So we've got to acknowledge that. And that, I think, is what has changed. We just have had so many cows added to herds, especially across the U.S. southern and central plains. We've had some decently sized yield growth expansion in U.S. milk as well, at least last month. And so just the mathematics are that we're producing more milk than ever in the U.S. And the recovery has been pretty swift and pretty robust. It's also happening in Europe and again happening in New Zealand. So we just have to acknowledge that there's really no shortage of milk supplies in the world. I think on the other side of this, though, we're still pretty optimistic, all things considered, for dairy operations. And that's just because I think feed prices will be incredibly cheap. We're thinking that, or at least providing the framework to yield probabilities, and I know you've probably seen these scattered across the ag media landscape, but we think corn yield potential up to 184, 186, 187 it is very real, or it's not unreasonable. It's going to be one of those to really prove that you've got to get combine results, and you need to factually confirm that that's what the trend is in terms of U.S. corn yield. But I do think there's a non-zero chance we have a U.S. corn yield above 185 bushels this year. That is going to be added to what we know is a pretty large U.S. wheat crop, thinking about the hard red wheat crop across the Western Plains. And we'll kind of take that journey looking at the feed markets later on in the episode. But also sorghum. Sorghum's faced the same, generally favorable growing weather in Central Plains. We're not exporting enough of it. We think that there is a risk that U.S. sorghum stocks could be the highest in a couple of decades. So I know it's not a huge market, but when you put all these things together, record U.S. corn yield potential, large wheat supplies, large sorghum supplies, what does the feed market have to do kind of across the spine of the U.S. to clear excess inventory? So I do think that cash markets will be pretty deflated when we think about feed markets, starting in the autumn months. And then the duration that the feed markets stay deflated, it's kind of the next game. Does it take 18 months to clear supplies? Where is the next weather problem? And also the trade deals. We've kind of announced things from Indonesia, Japan, and something with the United Kingdom. But so far, I don't think any of it's been ag specific, or there's been some memorandums of understanding in that. Bangladesh will buy 700,000 tons of wheat per year at some point, but nothing's really been concrete. And does that mean a lot? Is Bangladesh or Indonesia going to buy a lot more wheat from the U.S. than they are currently buying? Those things are still pretty murky, and so we don't see a lot of evidence to support guaranteed larger crop exports at least. So putting this all together, I mean, I do think that there's room for recoveries in the milk market. And even the Class 3 market today has not reacted terribly bearishly to a surprisingly large June milk production figure. Demand worldwide in the U.S. is still record large. So again, there will be recoveries, but I think we want to communicate very clearly and sort of at the opening here, be prepared to hedge, downside risk late 2025 and into Q1 2026. Seasonal trends we're all kind of aware of. That's always the weakest part or of the calendar in terms of milk pricing. And that's just because we don't use a lot of dairy. Oceania produces sort of peak supplies just before that. Is there $15.5, $16 Class 3 in February and March? I think there's a non-zero risk that's the case. So we want to pass that risk to someone else and manage margins properly. I think for now, it's sort of, ratcheting down fair value from, 17.5 to 19.5 to maybe it's just 17 to 18. The beginning and end to this, again, is just supply and global milk production, even U.S. milk production specifically. So in June, production was 19.23 billion pounds, is up 3.3% from last year. And so the last 2 months especially, we're kind of back to pre-COVID levels of growth. And in fact, in June, we're kind of at a very special number of growth when we look at 3% compared to the last couple of decades. So again, the speed that U.S. milk production has recovered and the intensity as well are both kind of factoring into just thinking about the processing industry, not having any shortage of supplies. Regionally, it will be different. You're not seeing a lot of growth in places like the upper Midwest, but again, places like Texas, Kansas, South Dakota, just an abundance of milk. And does that have kind of a spillover effect into the rest of the national cash market? So I think once again in the USDA's August WASDE, they will have to raise their milk production forecast, another 200 or 300 million pounds. So all of a sudden, we've gone from zero to negative growth through the very end of 2024 to now we're growing annual U.S. milk output by 1.2%. And we already know we're very good at producing components. So again, I don't think any processor is going to face any kind of shortage of supply. So that's not a concern of the market. There could be kind of periodic bidding wars just because demand is record large in the U.S. and globally, but I don't think the processors will really be outdoing themselves to get their hands on supply. So that's kind of philosophically what we think about the milk markets. And that's different from where it's been the last, 3 years, ending in the latter part of the spring. And the story really just centers on, cow herds. We've added 114,000 cows to the herd. Since December 31st, 62,000 of those, or about 60%, are centered in Kansas, South Dakota, and Texas. Minnesota is also up 3,000, but Wisconsin's herd is 0. So I'm not sure if the Wisconsin cash milk price probably outperforms the Central Plains. But again, the sort of knock-on effect from just having a lot of milk nationally is important. And it was a pretty special report in terms of changes in production. So we kind of ratcheted up the previous month, so the month of May's herd size and production just a little bit. But we did see the national U.S. milk yield just over 2,000 pounds, and that was up 1.7% year over year. And so we are starting to kind of really climb ourselves out of this hole that we've seen since the end of 2022, and that we thought growth was kind of never to be seen again. Did we reach something like peak milk yields? Just because in the U.S. they're very high, and we're double what we see in a lot of places in South America and Eastern Europe. It just might be more difficult to grow yields, but the June report said that at least for now, we are growing adequately. So, again, 1.7% year over year. California, and that's where a lot of this, I think, was centered. California up 2% from last year, and growth in California's yield for the first time since last September. So we kind of knew this was coming, but bird flu seems to have come and gone. And even the worst places, the West Coast, they are also kind of back to normal production levels, back to normal growth levels. Colorado's yield was also up 3% from last year. Wisconsin's was up 0.7%. So again, there are regional discrepancies here, but I think that bird flu is no longer an issue. We're adding cows to the herd. That is important to at least acknowledge. This kind of shows you the sort of meteoric rise in cow numbers in places like Texas and Kansas. There's places that were hit pretty hard early on in bird flu spread. So since September of 2024, the Texas herd is up about 40,000 head. And we've kind of heard anecdotally like the largest dairy operations there, the ones with 250,000 head, and kind of move up and down depending on profitability and milk prices and component prices. And it does seem that, the 11 months previous that we saw national all milk cash prices above $22, and mostly above $22, for the most part for the last 3 years. I think that has provided the incentive to push the button to add to cow herds in places like Texas and the Southern Plains. Kansas also, I think kind of the beginning of bird flu, patient zero there. Now we've added about 20,000 head in the last 4 months to Kansas. So there's a lot of cows. And it doesn't even seem that it's being impacted by this incredible beef cow and beef market. Like we saw the last couple of years, we thought that might act as a cap on increasing heifer retention. Cows are just so valuable now for their meat, more valuable than they've ever been. But again, what we've seen and what the data is telling us is that it's kind of secondary to people adding to the active dairy herd. And so since it's not happening at record cow prices, I think we've got to assume that the cow herd kind of stays where it is. Maybe it drops a little bit. But for the rest of 2025, I do think we've got a lot of cows to milk, and that helps production grow kind of indefinitely at this point. But it's not just the U.S. And I think a lot of what we're going through here is just kind of explaining what Class 3 has done the last 4 weeks. It's been very weak. The rally we saw before that was very short-lived. So I think the reason why is because the cash market, the physical processing market, kind of see and feel in real time this milk coming at them, whereas the rest of us can't see that until we get kind of data that's always in arrears. We're just watching the markets. But it's not just the U.S. that this is occurring too. I mean, we really thought that Europe would struggle to grow milk production, maybe for the next 5 years or 10 years. And I still think there are a lot of challenges in Europe and the United Kingdom specifically. But at least in the short term, they've kind of shrugged off that trend, and they are producing more milk. So, EU production in April was, 14.5 million tons, up 1.4% from previous year. And that was a surprise. Given Netherlands, too, still contracting. And that's one of the largest producing countries in the European bloc. But the official data, when we add all, 28 countries together, 15,000 tons, up 0.8% in the month of May. It's the latest data that we've got available. A lot of this is centered in Ireland. Ireland's doing very well in producing milk. So thinking about the Kerrygold butter market, that company is not going to have any shortage of supplies. So they'll be pumping out a lot of butter. But even places like Spain, United Kingdom, Germany, just kind of hanging in there, fractional growth, but growth nonetheless. So Europe, United Kingdom, adding to global milk supplies, especially dairy products that are in exportable position. So that's what's changed. We have highlighted, intermittently in the Dairy Signal that this is kind of the beginning and end of milk outlooks, at least for kind of short and medium term. If these bars are below zero, you're generally in a supportive to bull market. And if these bars are above zero, you're probably in kind of a neutral to bear market. And so we have been in a neutral to bear market last month. And I think this is the reason why, is because of supply. It's been a supply-driven market the last couple of weeks. And New Zealand as well. Again, another place that we thought, pasture issues, genetic issues, maybe New Zealand production growth was going to be very elusive for the next decade. And I still think, like Europe, that there will be a lot of challenges at Oceania, but for now, they are growing milk pretty adequately. The caveat to this is, and I'll show you the Southern Hemisphere, Oceania specifically, again, one of the largest dairy exporting regions on Earth, rigidly seasonal production, more so than the Northern Hemisphere in the United States. So we're only comparing, very, very small numbers. So New Zealand production in the month of June was just 260,000 tons, or about 500 million pounds, kind of at the zenith of their production cycle. But that was up 15% from where we were a year ago. So the question I think we're thinking about, and time will tell, does this set the stage for production growth of 4-8% once their output seasonally rebounds to peak levels between October and December or so. So I think we're probably dealing with high odds that Oceania production continues to grow and grows at a point when they're producing lots of milk. And that period's now only weeks away. So they're seasonally, you start to kind of the surge in milk kind of comes back beginning in August, really peaks between September and December. And so we're at the very, very low point today. But then thinking about this I think explains a lot of the real seasonal trend in milk prices, which tends to work kind of year in, year out. It always provides you at least an initial framework for where milk, cheese, and butter are and where they're going. We don't produce a lot of milk in competing markets during kind of late spring, during our summer. That changes, August, September. We also use a lot more dairy products after our winter. But we're kind of at the end of this period now. So it kind of the Band-Aid has been put on the U.S. milk market because of really large production growth. And now I think there's not much urgency, let's say, on the end user community globally, because we can see that we've been building cheese and butter stocks in the U.S. We're exporting large amounts, but this Oceania seasonal increase in production in Oceania is really just 30 days away. So I don't think anyone's going to chase milk prices globally higher because they can see what's happening in places like New Zealand, production growth, probably growth starting in August, September. Lots of milk will be produced. And so there's, again, supply-driven market so far. And we have seen for the first time in many months that the global cash prices and the global auctions benchmark prices have been extracting premium, not adding it. And I think that the rally in things like butter and cheese and even the skim milk powder has paused is just because production has exceeded expectations in almost every single exporting country. Australia still contracting, but they're kind of the smallest of the big four, those big four being the US, Europe, New Zealand, and Australia. The New Zealand, Europe, and the US growing. And that's, I think, what's capped the global market. And so you can see here that we've kind of made it through peak butter price season. The global auctions butter price, as well as cash prices in general, physically traded prices in places like Europe and New Zealand tend to peak in July. That is, almost a given every year. You can kind of see here that it's at some point between July 1st and July 30th, the global butter market does peak. It's been extracting premium pretty slowly, and I don't think we have solved butter's real supply issues now, but could just see sort of the global auction price or the New Zealand price slide back to $3 per pound versus the current price of $3.40 by November or December. That is most likely the case. You can see cheese as well. We kind of peaked at about $2.50 in May, and now we're down to $2.08 per pound. The auction's cheddar price 2 weeks ago was $2.20 per pound. So it does seem like higher production globally, and maybe even in New Zealand specifically, is acting as a weight on global markets. And that's what's been the big driver for US Class 3 milk rallies, is seeing export data. We're exporting lots of cheese. Then you take the snapshot of the current global market, and we're still very, very cheap, so the market rallies. But that is beginning to change because of these supply-driven markets. It's a lot of production in the U.S. and in competing markets. So I don't think it's all doom and gloom. I don't think the outlook's terribly grim. And again, I think even today's kind of positive trade in Class 3 is telling us that maybe it's not so fast. We are still using a lot of this stuff. So maybe not until Q1 2026 do we have the next leg lower. And also because of demand, and I think because of demand for fat specifically, we have had a pretty decently sized premium when we look at all milk cash prices nationally and by state when we compare them to Class 3. The relationship is normalizing relative to where we were, during the peak bull years, 2022 to 2024. But we do think that there's still going to be a $2.50, $2.80, maybe $3 premium in the all milk cash price when we compare that to Class 3, even Class 3 settlement today. So here's kind of our very loosely correlated model, and probably official numbers in July and August, anywhere from $19.80 to $20.25 per hundredweight. And taking that a step further, that's probably the cash prices that we'll see on a monthly basis through the rest of 2025. So I don't think kind of sub 1950 cash prices are on the table, because there's still a lot of value in milk. The milk does not have to be at $22. Again, we're producing too much of it to sustain bull runs. But again, I think that given record demand both domestically and globally, I think 1750 Class 3 is valuable to a lot of people. And so that's why I think we are going to see cash prices close to $20 for the next 6 months. So we're not terribly concerned about total revenue compared to feed costs, just that the market has corrected. And what we want to present today and communicate is that hope for lasting rallies in milk have eroded just because we're producing so much of it. So let's all be cognizant of that. But to the demand point, still where we are. So it's hard to be real bullish of U.S. cash prices if markets in New Zealand and Australia are going down. They're not going up. But U.S. cheese and butter are still ultra cheap in the global market. So even as of last week, these are physical cash markets. European cheese was trading at $2.44 per pound That is up 1 cent on the previous week. Oceania was still $2.16 per pound in the cheddar market versus $2.25 the previous week. But U.S. blocks anywhere from $1.67 to $1.70 based on USDA sales reports. So I still think we're going to see, we had a bearish milk production report this week. In 2 weeks, we'll get export data. I imagine that will be fairly bullish of cheese. We're going to export, I am sure, for another month, the highest amount of cheese for that particular month. That will be June data. So a lot of this stuff is going to disappear. It's just that the balance is kind of tipped the other way because of U.S. production. And in butter, we're going to be a net exporter of butter for the foreseeable future. European butter is still $3.85 per pound. Oceania butter, which has been extracting risk premium, still about $3.45 per pound in the cash market. U.S. just does nothing within a range of $2.50 to $2.55, and that's fine. There's no need to ration butter supplies today, but we are going to make a lot of this stuff disappear domestically and in the export market. And so again, we have relative optimism, especially when compared to the row crop markets. But it's no longer like it was basically 2021 onward, a function of milk prices, but it is more centered on margins. And so this shows you just very simple spot futures, class 3 milk to corn and class 3 milk to soybean meal ratios. So we're above average. We're actually at pretty special levels when we think about protein meals. And we don't think that this changes anytime soon. And in fact, is maybe as neutral as we are class 3 at about 17 and a half. I suspect that these ratios get a little wider, at least between now and, middle part of November. The class 3 milk to corn ratio today is 2.44. I think that can get up to 2.55, 2.6. So I think the sort of milk feed ratios do get a little bit better, and so that's kind of where our focus is turned. I still think we need to produce adequate amounts of milk because demand's record large. It's just it doesn't take as much to get that done given where feed costs are today. So the other side of the milk price decline, one, it's supply and production, but also just kind of input costs coming down. So that's milk doesn't have to do as much heavy lifting when thinking about sustaining production levels. And it really is just weather to us. There's really no secrets. I mean, it's the demand driver that's been so elusive in the markets. I don't think there's much in the way of ethanol. It's Chinese trade deals. Does China need not 2 million tons of corn imports, which is what we think they'll import this year, but do they need, or can we convince them to import 15 or 18 million tons? And that was not really the default scenario, even coming into the burgeoning trade war. And I think it's still going to be very difficult to get an ag-specific trade deal with China through the rest of this calendar year. So it's not really, I don't think, really impacting markets one way or another. Rather, it's just been central U.S. weather. I think, regionally there are issues. Everyone's farm is different. But when we look at the big picture, the annual balance sheet has been nearly ideal. And so on the left, you see July 1st to July 23rd, percent of normal rainfall and just how wet it's been in places like Iowa and eastern Nebraska and eastern South Dakota. Again, those problem areas that we've seen the last 5 years. Anecdotally and based on vegetation health, I think that you're dealing with kind of record dry land yields in Nebraska. I think South Dakota and Iowa yields recover. And just kind of how big is big in places like Iowa and Western Illinois will be the question as this kind of the slew of crop tours begins in the next couple of weeks. There have been pollination issues. I mean, we do not want to dismiss that. I don't know if it's just, relegated to certain hybrids, certain planting dates. I think you can find as many good ears pollinating as you can bad, but I don't think it's going to be an issue for national corn production. So on the right, you've got vegetation health, just isolating crop areas as of July 19th. You can see we're way above average, really everywhere, but kind of scattered areas of the Dakotas and parts of Minnesota. We need to dig into the numbers. Iowa's vegetation health statewide is the highest it's ever been. Same thing with Nebraska and large parts of South Dakota. So as long as Illinois, Indiana, and Ohio kind of hang in there, that's how you get to these kind of monster yield estimates of 185 to 186. I know some of these estimates have been dismissed, but the math isn't that we've got some kind of new genetic improvement or we've crossed some threshold in productivity. It's just the coverage of yields, 1% above trend. When you start to include Colorado and Kansas and Nebraska, and you got a 205, 210 yield in Illinois, and how big is big in Iowa, that's how you come up with mathematically a national corn yield of 185, a soybean yield of 53. And so that, I think, is still the risk in the feed markets. Still nuanced. We are not out of the woods yet. It still needs to rain, and we need to avoid heat in August, but it does seem like this pattern that has been pretty not stagnant, but pretty well set up. And that west of the Rockies is just terribly hot, terribly dry all the time, but you've got pretty normal conditions everywhere else. That's been the pattern since June. I think that probably stays that way into the end of August. And we did think that maybe, heat, dryness, the long-term climate forecasts were pretty committed to heat and dryness really west of the Mississippi River until we got into summer. And so those, previous, those climate forecasts in April and May kind of busted. And actually the opposite has occurred this year. So just kind of a side note there. And going home Friday, we did have some, pops in the feed markets, soybeans, corn, wheat. There was a threat, the forecast going home last Friday, it was going to be hot and dry for the foreseeable future, especially in Nebraska, Kansas, Missouri, Iowa. Quietly, that's gone away. So all of a sudden, not even this week, we're going to be terribly hot in the Western Plains. And so going kind of clockwise in this graphic, we've got temperature anomaly forecast. So starting in the upper left, 1 to 5 day, to the right, 6 to 10 day, and on the bottom, 11 to 15 days. So it's going to be hot today. It's uncomfortable. Tomorrow as well. We're going to see some periodic heat for another 5 days in the eastern Midwest. But then the pattern shifts, and it seems like odds are high or probabilities favor this kind of mild first 7 or 10 days of August. So this heat event will have been pretty short-lived, all things considered. And so we are going to keep in place the idea that the risk in the feed market is for these monster corn, soybean, and sorghum yields. I think that is, again, the risk even at today's prices. No shortage of water either. So just wanted to present what we're kind of dealing with, given we've got probably this temperature forecast change going to be pretty mild. Crop ratings are already very high. On the left, you've got the U.S. Weather Service's 3-day precip accumulation forecast. And I just highlight the 3-day because it's been kind of hyper accurate. Those have a lot of verification behind them. So more soaking rain, really most of Kansas, but particularly the heavy kind of sorghum corn areas. Northwest Missouri, kind of a hot spot, very hot, has been fairly dry. They get blessed with 1 or 2 inches of rain. Iowa gets more, Wisconsin, the southern half at least, and then the northern part of Illinois, where drought is still present today, gets 1 or 2 inches. So again, a lot of issues that do exist, or what issues do exist, probably get solved in the next 5 days, going into the weekend. On the right, you've got the European forecast probability that rainfall in the next 10 days exceeds 1 inch. And so you kind of see this line that stretches most of the most concentrated corn, soybean production areas, an 80 to 100% chance that eastern Kansas, Nebraska, Iowa, Illinois, Wisconsin, and Michigan do get 1 inch of rain in the next 10 days. And you kind of have some scattered areas, key parts, South Dakota, Minnesota, North Dakota. So again, soil moisture issues today seem to be confined to North Dakota, maybe the northern third of Illinois. And those two probably get solved in the short term. So are we dealing with, drought coverage at 3 to 5% of the U.S. Corn Belt on August 15th? Again, there's non-zero chance that that occurs. So again, it's just been weather has been very good. Feed markets have reacted appropriately. And so here's kind of the method that we get to, and again, the non-zero risk that U.S. corn yields at or above 185 bushels an acre. So crop conditions, can't get into the details, and people either love them or hate them, but they can kind of give us a framework, or at least we can fine-tune probability. So what stood out to us, one, that it did seem that cool weather in May did limit sort of the beauty of the crop. So we started out pretty weak. We recovered 74% good, excellent, and that's been the case the last 3 weeks. And seasonally, almost every year, crop ratings peak, 1st of June, drift lower into harvest. I guess once you start to grow and add tassels, corn crops, I suppose, get uglier, and so they're just rated more poorly. This is all built into these yield models. But we haven't seen that. It's been kind of counter-seasonally rising since the second half of June. And so when we isolate years, let's just go back a couple of decades, years that on July 20th, the U.S. crop rating is for corn is 70% good, excellent, or better. This is kind of what we get. So 2010 was the anomaly. People are kind of thinking about this year. Is there something to really drive down USDA yield forecast in October when we get real harvest data? I'm not sure if that's the case, but otherwise probabilities do favor a yield 1 to 3 to 15% above trend, which I don't think we're going to be dealing with this year. But 184 bushel an acre yield is where ag resource is today. That is a yield 1% above the mathematical trend. So again, I think that makes it not unreasonable, especially thinking about last August, September, the crop yield as estimated by USDA was almost 184 anyway. So the ingredients are there for this. 187 is 3% above trend. And so you're all of a sudden adding 100 millions of bushels to the U.S. balance sheet by just kind of a non-special yield when we compare to trend. And we haven't exceeded trend since 2018, but is this the year that happens? So I wanted to highlight that it doesn't take much mathematically to get what looks like a very, very, very large U.S. corn crop. And it kind of expands that. So we're going to go on this journey and think about what we think about feed markets, why that is. And our concern is downside risk into harvest, which is not atypical, especially, Chicago futures declining from July 24th to September 15th. That is almost a default position. But the duration is what we're thinking about. So our balance sheet, similar to the USDA's in old crop, 1.34 billion bushels. This could be smaller. We're still exporting lots of corn. And I think this comes down to really just planting 5 additional million acres. That it's just hard to combat that with weather or demand. So our yield's 184 bushels an acre today. If China doesn't come back to the U.S. market, Brazil produced a record crop this year. Argentina's production was very large. It's probably going to be more competition for demand, maybe about mid-August onward. So we're less optimistic on exports, but even using 2.6 billion bushel of exports, kind of the story is the same. So we think in 25, 26, we end the season with, U.S. corn stocks about 2.3 billion bushels. We carry that over to the 26, 27 crop year. Let us cut acres 4 million. Those acres will go to soybeans. Assuming trend yield, we're still left with in stocks at about 2 billion bushels. So it just saying, again, none of these 26, 27 numbers are going to be exactly correct. But the general theme we want to communicate is that until you have either a pretty considerable demand driver, which we think would be China, or a weather problem either in South America or the Northern Hemisphere next spring and summer, you're kind of stuck with adequate to temporary oversupplied corn supply and demand. What gets us out of this somewhat of a hole is kind of where we're moving to when we think about markets longer term. But for now, it's just the 2.3 billion bushels. How do we clear inventories if we assume, demand stagnates just a little bit? And meal, the story is fairly simple. It hasn't changed. Crush margins, though, have crossed the $2 per bushel threshold. And that is not because of meal values. We will reiterate the EPA's biofuel policy and 45Z getting passed into the spending bill. We're going to have to use a lot of soybean oil to produce renewable diesel and biodiesel. We're kind of the devil will be in the details, but we're thinking maybe soybean oil consumption rises, 30% in 2026. We got to crush lots of beans. Again, it's not happening because of soybean meal, but I wanted to highlight some, news that came at us this week. We've added yet another processing plant, another crush plant in, about 100 miles west of Omaha, Nebraska, capacity of 50 million bushels. Soybean meal production will be pretty robust, I think, for the next, 2 to 4 years. And that's not new. We have seen this. This is all the advent of renewable diesel and eventually oversupply in the protein meal market. We've been up 6 to 12% every month since April. Cumulatively, meal production from the NOPA members is about 27 million tons. It's up 5% year over year. You'll probably see growth of 3 or 5% in 2026. And so the meal market's done what it should be doing. At what price can we get rid of all this excess supply that we can't really store? At what price do we encourage really importers to not only buy meal from South America, but also from the U.S.? And that's something close to where we are now, but we are thinking we could probably test 2015's low of $250 a ton and we stay at 250, 280 per ton for the next 18 months is the most probable scenario in the soybean meal market. If basis were to get weak, soybean meal, protein meal will be very cheap. So this is going to help a lot of feed operations. Corn as well. We're not sure, given what we've talked about in terms of weather, supplies, in stocks forecasts, what prevents us from testing last year's seasonal low when the balance sheet, at least at this time of year, looked pretty similar. I know we had ultimately some weather threats, smaller than expected yields, but I think what really drove the market in corn post-harvest last year was we were the only place with an abundance of corn. It wasn't Brazil, it wasn't Ukraine. If you remember, Eastern Europe, Ukraine had pretty crippling drought in the summer of 2024. So we were the place to go. So export demand drove us from $3.60 to $5.20. I don't know if we'll see that again this year. Feed market's oversupplied. So again, we've kind of dropped to initial chart support, this kind of glaring open chart gap left last August, $3.95. And so maybe it's worth pausing here. We could chop around. We got the August USDA report just in, over a week. We'll see what they think about yields. We'll see what pollination, how it, develops as it, gets completed in the next 2 or 3 weeks. But ultimately, I think the risk in corn is something like 360, 370 September and December contracts. So again, the chart doesn't look terribly healthy today. But I think what's not being missed, but where we want to take this a step further is go into the journey of looking at the entirety of the U.S. feed market. And again, this is why I think dairy operating margins improve even at class 3 milk prices where they are today. So the USDA last month, or in early July, gave us their first pass at by-class wheat balance sheets. And none of this was a surprise, but because we produce pretty large hard red winter wheat yields, we're carrying over a lot of supply into the 25-26 year. They have estimated, in stocks for 25-26, 432 million bushels, and that's the highest since 2019. So that market needs to find some way to either, increase total feed demand or in the export market, get people to buy U.S. wheat, not Russian wheat. Some of this is happening. So exports, and again, this assumes that exports of hard red do expand by 60 million bushels this year, which I think is reasonable. I mean, we're actually finding consumption here. We're shipping a lot of hard red wheat, and we're selling a lot of hard red wheat. But even if we were to dial in, export demand growth of 100 million bushels, you're still left with something like 380, 390 million bushel end stocks. Kind of a long-winded way of saying the hard red market's pretty amply supplied, and this does provide competition for feed, at least in places like Kansas, Nebraska, Texas, and Oklahoma, which is in pretty, heavy livestock areas, highly concentrated. So this is kind of something else. I know people have been focused on weather, corn yield models, and corn production and stocks, but I think it's the sort of fringe markets that give us concern over this lengthy period of deflated corn values. And even in wheat sales, again, we're up 70% year over year with hard red winter wheat sales, 127 million bushels total. It's been pretty good. I just don't know if importers are kind of restocking to fill bins as we get into, tariff season again. Remember, it's August 1st is the deadline for a lot of countries, and getting trade deals or prohibitive tariffs. So are people kind of offsetting that? I don't know, but the hard red market is going to be pretty robustly supplied no matter what. And then sorghum as well. So we will get into the weeds, for better or worse. But China is always the principal buyer of U.S. sorghum. We have been at odds with them, for years. This is not new to January of 2025. So I think the old crop sorghum balance sheet is getting looser pretty considerably, and the risk is the new crop balance sheets stocks swell to a level we haven't seen since the early 90s. So we've only averaged the last 3 weeks, 800,000 bushels of export sales. Total commitments about 67 million bushels. That's 67% of the USDA's forecast. And you can kind of see here that's too low. This compares, how much we have sold to date as a percent of the USDA's forecast, and you want to be near the black line essentially. If you are below the yellow shaded area, USDA in its next WASI report will be forced to lower exports. That's essentially what this is saying. So probably they add maybe 10 or 15 million bushels to the old crop U.S. sorghum balance sheet. Supplies will be robust. Even if we add outstanding old crop sorghum commitments, let's assume that those get rolled into new crop. We today have only committed into the world market, 6 million bushels of U.S. sorghum. That's eight. We were, as of mid-July, we were 18 million bushels last year, 45 million bushels the year before that. If we were just isolate what has been actually sold for new crop delivery, it's only 11,000 bushels. Sorghum interest, for all intents and purposes, is zero today. Like corn, like soybeans, even select states' spring wheat ratings, conditions have been very good, 68% good excellent as of July 20th. It's at the upper end of the historical range and well above the last 3 years. So we think USDA may be forced to raise sorghum yield by half a bushel to a bushel an acre. So this is what this looks like, I guess. So again, a Chinese trade deal could change this dynamic pretty considerably, but we think we're going to be carrying over 66 million bushels of sorghum. We've raised yield about a bushel an acre relative to the USDA. We have lowered exports. USDA is very optimistic. They think we're going to increase sorghum exports next year by 150 million bushels. We don't think that will be the case. If it is not the case, you're left with 90 million bushels of sorghum in stocks at the end of the 25-26 crop year. And for context, this is what that looks like. So this would be the highest stock number since 1992. And again, this is a small market, not even a futures contract, but just want to think about the physical cash market, again, across kind of the spine of the U.S., especially the Southern Plains feed market, when you've got ample hard red, higher year-over-year corn production, ongoing abundant meal production, and sorghum stocks with nowhere to go. So that's kind of maybe the next driver of prices as we get into harvest. And again, just want to communicate that there still is risk in the feed markets, because how do we clear inventories is the next question once we get past maybe the August or September USDA reports. We're not going to run out of storage, but I did want to show you, we've done this work at AgResource. I mean, it just acknowledging that capacity has plateaued at about 25 billion gallons. We've been adding, 10 to 30 million, bushels, 10 to 30 million bushels per year, but that's about it. And so probably our combined corn, soybean, and wheat production estimate is about 22.8 billion bushels. It's up 300 million from USDA. We're just going to be stretching it a little more than we have been the last decade or so. So this is the highest. We think that major crop production, corn, wheat, and soybeans combined, will account for about 89% of existing storage capacity. And we haven't seen a number higher than that since 2016. So again, this doesn't get you any closer to nailing, market lows or exactly what basis does, but we have seen basis be pretty weak when we are up against, 90% of storage capacity. Thinking about the feed markets, just all crops combined, they're going to be available in abundance. We've already got some kind of template for what's happening in markets like sorghum and hard red wheat. And it's not even really new, but those markets do seem to be probing for a price that gets rid of this stuff. Now, this is in Hays, Kansas. Sorghum basis is $1.15 below spot Chicago corn futures. So you are sub $3 per bushel in the sorghum market today. Western Kansas and Garden City, the bid is 75 cents under the KC wheat market. So you're at about $4.50 per bushel there. So again, I think just putting the pieces together, this is generally what we thought would happen, just the large supplies. What does that mean? And taking a look at cash markets, it is markets are trying to clear excess supplies, and that's what we're concerned. Maybe happens in corn come October and November. But again, it's not all doom and gloom, I think, for the dairy space. I think that the recoveries, there are ingredients for them. I think we do find support here at about 17 between now and December, January of 2026. The dollar is sagging. The euro is still very expensive relative to the last 3 years, which only matters if we're competing with Europe for some kind of exports, which is not the case. Things like corn, soybeans, but is the case very much so with dairy products. But I think this does lend even more support for U.S. cheese exports, staying record large. So that gives us ingredients. And again, I think 17 and a half class 3, while fair because of production gains, there's valuable. There is value in raw milk at that price. And kind of our every bi-weekly checkup on the whey market, it's doing what it always does. This is inverse relationship to, I think, milk production, total milk production. And so, milk production is peaks every year, May, June. That's the case even despite year-over-year growth in the U.S. And so I think the whey market's on its way to 70, 75 cents per pound. So just thinking about, a volume of raw milk, it needs to be less expensive than it was 2 months ago, but I still think there is value in that. And unlike corn, you got demand growth, you have record demand. So I think that gives us, again, hope for recoveries. Just want to use those recoveries to manage forward risk. Again, the high level things are in the milk markets, production growth larger than expected in the US and also happening everywhere else in the world. So is there a time next January, February, we start to take some shine out of US cheese exports, things like that? So I think it's time to start thinking longer term, and maybe we're in this more intense supply driven bear market in milk. So that is a rundown. As always, there's lots to talk about. There's a lot of information. So if you need anything at all, you have other questions you don't want to get to today, here's my email address. Please don't hesitate to reach out. So again, thank you for your time.
Well, thank you, Ben. That was a lot of information. We did have a question come through. With yesterday's trade deal with Japan, how do you see other countries lining up to make a deal?
Unsure. Unsure. I think the idea is to kind of put China in a box. That's, I think, why we're going after everyone else first. But I think that there is a push to get deals done, I'd say, but I want to be very honest. I don't think many people or anyone, and certainly not us, we don't know what is in those deals. We do not know whether it's sort of a framework to do something later. We don't know if it includes money, allocated to ag specific purchases. So I think that still the risk of, tariffs coming into the U.S., whether it's 10 or 15%, and we're not sure if that translates into Japan buying more milk or more corn or wheat. Just a lot of unknowns. But I do think we're going to see a flow of announcements from kind of the fringe Southeast Asian countries in the next week or so.
Perfect. Well, thank you. With you covered a lot of information today. What are a couple of key messages or takeaways that you want listeners to take home with them?
Yeah, I think is be prepared to lock in margins. Again, I know we're kind of neutral milk or bearish feed, but seasonally, I think the corn market, for example, probably doesn't bottom until second half of September, maybe. But the market has bottomed between like August 10th and September 10th, many years in the last decade. So just be prepared to start kind of being more protective of your balance sheet. I don't think you need to do anything in the feed space this week or next week, but second half of August, start to put pen to paper, see what things work. Locking in milk, locking in feed, just kind of guaranteed margins exist, where they should, and I think where they are today. So I guess in the next 30 days, give everyone a bunch of homework, start looking at P&Ls a little more intensely.
Well, thank you, Ben, and everybody at Ag Resource Company for your continued support of the Dairy Signal. And thank you once again for DMI being today's sponsor of the Dairy Signal as well. We wish you a wonderful weekend and look forward to seeing you next Tuesday here on the Dairy Signal.